No, thank you for doing this.
Oh, here we go.
I think we're live. Participants are joining now. Just give it a moment. All right, I'll kick off. Good afternoon, everyone. My name is Stephen Connors, CEO of the FSAA, and welcome to our third complimentary webinar for members since the COVID-19 outbreak happened. On a positive note, the FSAA has now had to upgrade our Zoom membership due to the popularity of these sessions, and this one is no exception to that. We also have the opportunity to welcome some participants from overseas in the Philippines today, so truly a global audience. Before we launch into today's webinar, I'd just like to bring attention to a couple of events next week as well. We have an accounting and reg update, which is always quite useful, which is on Thursday at 12:30, and the AASB update also on the accounting implication of COVID-19. And that's with Dr. Keith Kendall, the new chair of the AASB, and Helena Simkova, and that's at 10 a.m. on Friday next week. Now over to today's session, tax basics for general insurance. It's quite a dark art world, and I understand, based on the population of and experience of our membership base, most of us are actually working in financial control, and we often rely on our internal and external tax specialists quite heavily. And it's really great to get the opportunity to just get a bit of a refresher in this on a basic high level. It's probably never the opportunity to go too deep into any of the individual tax topics, but to get a high level understanding is always useful. So hopefully you find this useful today. I also have the good fortune of working with today's presenters. We have two senior managers from QBE Tax, Corinne Glanville and Michael Gerard. They are both have many years of experience in this space in direct and indirect taxes. And I'd say that they're truly leaders in this field. But one thing I'd just like to point out, they really have a knack for making tax fun, and that's no small order. So thank you, Corinne and Michael, for doing that at QBE. So I'm really looking forward to today's presentation, and as you say at QBE, tax it up. And over to you, Michael and Corinne, and thank you for doing this today.
Thanks, Stephen, and hi everyone. That's you certainly set a bit of a challenge to make tax fun. We'll try and do that for you, though. I would have liked to have started today's session and said it's great to see so many familiar faces. Unfortunately, all I can see is the slides in front of me, but I know you're out there, and thank you for coming on. So my name's Michael, and I have the pleasure of hosting the first part of the session, dealing with direct taxes. And following me is Corinne, who will be dealing with indirect taxes. And on behalf of both of us, we would like to thank the FSAA for the opportunity to present in today's session. We're both big fans of the work the FSAA does in developing its members, and certainly we have both benefit from the FSAA in the past. And also too, I was thinking to my first FSAA events in 2009, when the big red dust storm blanketed Sydney, which I'm sure most of you remember. And just like that day in 2009, hopefully today's session will also be one to remember, but for different reasons. So we certainly hope you get something out of the session. I should first mention that this session came about in recognition of the fact that finance teams are increasingly expected to be multidisciplinary with understandings of tax, capital adequacy, finance systems, planning, budgeting, as well as technical reporting. There's quite a lot you're now having to dabble in. Recognition of this, Corinne and I have pulled together a fairly high-level pack that will hopefully go some way to enabling you to at least identify some of the tax sensitive items or issues. And I'm sure if there's other topics that are of interest, get in touch with the FSAA and they'll do their best to help accommodate those. So bit of a laundry list of an agenda. We might as well just get straight into it. So general insurance from a direct tax perspective. Now, the income tax rules dealing with general insurance are fairly straightforward and are covered by Division 321, or as I've heard a PwC tax partner describe them as the blast-off provisions, as if we were counting down for a rocket launch. These rules are quite prescriptive and they set out the methods in which we calculate income and deductions for outstanding claims liabilities and unearned premium reserves. And while the rules are quite prescriptive, they do align to the accounting treatment, except for a few circumstances, which I'll touch on. And this was the policy intent, even though some of the concepts used in tax law are described slightly differently from accounting concepts. What I thought I would point out first is an interesting aspect of these rules, and it's the fact that the tax law allows the OCL and UPR balances to be determined based on proper and reasonable estimates. You won't find that really anywhere else in tax law where it allows proper and reasonable estimates to be used. So in this sense, it makes the blast-off provisions quite unique, and it recognises really the nature of our industry. So there are three main circumstances where tax and accounting deviate. The first is in respect of indirect claim settlement cost provisions. As you know, these are the incidental costs built into your OCL. They're non-deductible for tax. The second is where a LAT deficiency arises, the liability adequacy test. And that occurs where unearned premiums are inadequate to cover future claims. Again, this is non-deductible. And the third reason is where an insurer chooses to align the tax OCL to the one required by APRA, rather than the OCL that's booked in the accounts. So that's a bit of a choice, and the industry's a little bit split on that. But as you'd know, APRA requires 75% probability of adequacy on the OCL, whereas what you might maintain in the accounts could be higher for prudential purposes. So this then leads me to mention the ATO views on OCL. And while they consider it appropriate that sort of tax follows accounting, they've also expressed a view in the past that insurers might be modifying their OCL balance as part of a tax avoidance strategy. To combat this, the ATO has requested, but not compelled, insurers to sign an annual declaration to ensure there's no mischief in the OCL. So it's quite likely that your directors and executives are signing that declaration every year. It's also worth mentioning, as work continues to bubble away on the new accounting standard AASB 17, some more differences might start to emerge between accounting and tax, but this is yet to be seen. The industry is lobbying for tax to follow accounting, no matter what the outcome of AASB 17 is. However, life insurance is almost certainly going to be impacted. Hopefully not the case for us in general. Non-resident insurance. So some of you would have heard of non-resident reinsurer tax, also described as Division 15, as agent return or deemed profits tax. It takes on a lot of names, but it's all describing the same thing. And it's really a 3% tax applicable on reinsurance paid to non-residents. Some of you would have also heard it referred to as a withholding tax. And while it's not strictly speaking a withholding tax, it very much operates like one. In law, it allows for two methods that can apply to reinsurance. But the more common one is an election, which is irrevocable, to treat reinsurance premiums as deductible, recoveries as assessable, and then subject the reinsurance premium to 3% tax. So I'm just going to call out a few key features in respect to this. The first is that Australian law has imposed tax on a non-resident. And for all the tax nerds out there, this is quite a big deal. This is because the underwriting functions and all the risks are based overseas. And Australia's ability to impose a tax like this has been challenged in the past. So that's what makes it quite interesting. And to kind of combat that, the Australian government has negotiated the non-resident tax in its double tax treaties, but not Australia doesn't have a double tax treaty with every country, for instance. The second interesting aspect is the tax actually represents a deemed profit of 10%. The 3% that we're used to seeing comes about by taking a deemed profit of 10% and then multiplying it by the corporate rate of 30%. So a question you might ask yourself is whether the 10% represents a realistic amount of profit. The answer would most certainly be no. 10% profit is very aspirational, and these days global insurers maintain a combined operating ratio of closer to 1 to 4%. Now in respect of practical matters, the deemed profits is based on gross premiums paid or credited. Interestingly, gross premiums are not defined in tax law, so it takes on its ordinary meaning, which means we need to have regard to the terms of the reinsurance contract. I can't emphasize enough how important it is to review the terms and how things are described in a reinsurance contract. And while the relevant timing of the tax is when it's paid or credited, the tax will be retained by the insurer and not paid to the ATO until they lodge the as agent return, which is an annual lodgement. But importantly, it's up to the insurer to retain 3% because if there was any under collection, the ATO would seek recovery action against the insurer rather than the reinsurer. So it's our responsibility. And lastly, as a bit of a rule of thumb, when it comes to reinsurance, where the 3% non-resident tax applies, it's safe to assume that GST won't apply, and vice versa, where GST does apply, it's fairly safe to assume that the 3% non-resident tax won't apply. So the non-resident tax on reinsurance is a good segue into other forms of payments that need to be withheld from. The three that everyone would be familiar with is withholding tax on interest, dividends, and royalties paid to non-residents. What might be less clear is these headline withholding rates are subject to modifications. For instance, Australia's double tax treaties can reduce the withholding rates and respective interest payments. There can be an exemption for withholding tax from debt that is widely offered. And for dividends, if they're franked or whether they represent a distribution of conduit foreign income, then they're also exempt from withholding. So that's just worth noting. I should also mention that constructive payments are also liable to withholding tax. And a classic example is where periodic interest is capitalized into the loan rather than paid, and there's a liability at each capitalization point for withholding, even though nothing has been paid. So the moral of the story here is if you are required to make payments of this kind to a non-resident, you should just be mindful that there are numerous withholding considerations. And unless you're certain, you might want to engage your tax or treasury teams. And compensation payments. I'm not going to dwell on this too much, other than to say that insurers might also have obligations for PAYG withholding on claims, insurance claims payments. These could be under workers' compensation policies, accident and health, CTP, travel, business pack, or any other kind where the compensation is for lost wages. The tax laws dealing with this were originally for workers' comp, but these days it has a much bigger footprint. The withholding for these payments acts much like salaries and wages. However, you can be fairly certain that HR doesn't get involved, and they become more operational in nature, which is where the finance teams tend to get involved. So just now coming to the other side of the ledger and talking about income and instances where foreign sourced income received has been subject to withholding tax. There are a few dimensions in determining whether the withholding tax is creditable in Australia. First of all, you'll need to ensure this is an income tax rather than a transactional tax like stamp duty or GST. Also, you will need to check that the tax is paid, although it doesn't need to be paid within the financial year, as long as it's paid before the Australian tax return is lodged. And thirdly, you'll need to ensure the tax or the income to which the tax relates has been included in assessable income for it to qualify. So when accounting for foreign income tax credits, you would expect to see the P&L unchanged. And what I mean by that is we book 100% of income to 100% of the amount to the P&L as income. And the other side of the journal would be a debit to your cash account and your debit to your current tax liability. And the debit to the current tax liability is in recognition that foreign tax is creditable and is applied to reduce the Australian entity's tax payable for the year. Where a foreign tax is non-creditable, it's generally appropriate to allocate that straight as an expense to tax expense in the P&L. Even though there's a temptation to reduce your gross income, that's not necessarily appropriate. And as I mentioned, alluded to initially, a classic reason for an amount not being creditable is because the associated income is not assessable. So for instance, you might receive a dividend from a wholly owned sub, been subject to withholding tax. If the dividend isn't taxable in Australia, then the associated withholding tax is not creditable in Australia. Significant global entities.
Right. Very quickly, just while we're on the reinsurer, there's been a question that's come through, and it's probably a really quick one, so I thought we'd get to it. Does a branch of a foreign reinsurer require the 3% withholding tax if the branch repatriates profits back to head office? So if it was offshore.
Oh, it's really good question, and the answer is yes. And it's, I could talk about this for a while because there is some complexity in Australian tax law about how we designate branches, but the Division 15 has been set up to focus on the business of insurance rather than the legal entity. So if you're carrying on business through a branch in Australia, then yeah, you are subject to withholding. Great question though. Significant global entities. So I'm not sure how familiar you are with the term significant global entity, but there's a good chance you are working for one. It's an ATO construct which is used to determine if an entity is within the scope of these measures that I've listed here. Broadly, you are a significant global entity if your annual income is $1 billion or more. And The measures that apply to an SGE include country-by-country reporting, multinational anti-avoidance law, the provision of financial statements, increase in admin penalties, and diverted profit tax. So in the interest of time, I'll just briefly touch on the two that are most relevant for finance teams. The first one is country-by-country reporting, which requires the reporting of all international related party transactions. And this needs to be split by the different counterparts and by different transaction types. So you end up with a really chunky size of data. And as you can appreciate, it can be quite a difficult data grab, especially where finance systems don't have identifiers to distinguish between related party and unrelated party transactions. And it's further made more difficult by having to report the tax attributes for all of these transactions, which includes the country, the name of the counterparty, the nature of the income expense, FX gains or losses, average balances, transfer pricing methodologies, and agreements. So huge amounts of data attaching to every line. And tax teams often rely heavily on finance teams to assist with pulling this data together. And the second item I wanted to touch on is the increased administrative penalties applicable to a SGE. These can reach $525,000 for each instance of non-lodgement. And you'll find large corporates deal with many lodgements every year, crossing multiple taxes across multiple entities, in some instances, hundreds of lodgements every year, and some of which finance teams can be directly or indirectly responsible for. So it's really punitive, and while there was a grace period allowed by the ATO, that's since passed. And we just need to be incredibly vigilant on our lodgements. In respect of the ATO's priorities in the large business space, over the last couple of years, there was a huge focus on a justified trust initiative, which was a concept from the OECD. And justified trust is a move away from the traditional ATO audit approach of negative assurance to one which provides confidence that the taxpayers are paying the right amount of tax. So a much higher level of assurance. And this program started with the top 100 taxpayers and it's now expanded to the top 1,000. And so not only are these reviews very detailed, there's also a large focus on risk management and governance, which expands company-wide, including to the board. And the ATO is testing the design effectiveness and operational effectiveness of these controls. So you can be sure if you are providing inputs directly or indirectly into tax returns, you should assume that the ATO is going to be reviewing those inputs and the controls over those inputs at some stage. Now, since COVID-19, the ATO work is still ongoing with existing compliance action. However, new engagements have been postponed while the ATO diverts its resources to JobKeeper and JobSeeker programs. Okay, so lastly, I will just quickly rattle off some other tax matters that are relevant for finance teams. So transfer pricing matters are something the ATO is keenly looking at. And while you would expect well-established cross-border transactions like reinsurance and financing to be well documented, we should be mindful of other costs which can be more ad hoc, such as employees to comments and allocation of costs and service fees. So if you're responsible for cross-border recharges, it's worthwhile considering where the functions are being carried out and whether the pricing is at arm's length. Another area where you should engage your tax teams is in relation to the purchase of business assets, like portfolios, intangibles, or shares and subs, because the tax measures dealing with these assets can be a bit of a minefield. And it's one area in particular where the accounting and the economic outcomes can deviate greatly from the tax outcomes. Foreign exchange is also an interesting area to point out. Some organisations might have made elections where tax follows accounting and others might not have. But one thing I just wanted to say here is where FX gains and losses are in connection with the earning of non-assessable income, this might also cause the FX gains and losses themselves to be non-assessable, non-deductible. An example of this could be FX gains and losses on a non-portfolio dividend from a foreign sub. And lastly, on deferred taxes, I thought I'd just raise this in recognition of the COVID-19 and possibility of deferred tax on losses, but equally this is relevant for all deferred tax assets. The accounting standards require a company to demonstrate the probability that these assets will be recoverable from future taxable profits or future tax liabilities. So it's incumbent upon our finance teams to find the support for these deferred tax assets. And if you have a history of prior year profits, you might be able to point to these as a good support. You might also need to consider future profits, which requires forecasting and more difficult given all the uncertainty. But irrespective of the approach you think you want to adopt, you should engage your audit teams up front, because I don't think this is something you want to be dabbling with during your reporting periods. Yeah, so with that in mind, I will hand over to the more interesting segment of indirect taxes. Take it away, Corinne.
It's just 10%, right? So I'm going to have to sort of get you to take me through the slides, Mike, as you're presenting them. Thank you, everyone. Mike, that was really, really helpful. And I hope everyone got something out of it. I don't play a lot in the direct tax space. It's been a long time since I did have a lot of detail in there. So it's always nice to get a little bit of a refresher for myself. But from an indirect tax perspective, it operates almost a 180-degree difference to the way that income tax operates, and the reliance on both the finance function and the business more broadly in putting in place good systems and controls and processes to enable the correct reporting and compliance with indirect tax is really quite difficult and can be very, very layered and very very strategic, I guess, in how you approach and adapt the rest of the business to actually consider indirect tax when they're making decisions. But as we know, there's quite a few different taxes that can apply to a general insurance product, and they are governed both by a federal and state mandate, and everyone sort of wants a bit of the pie of general insurance premium, and dependent on the actual regulator, particularly on the states as well, you can actually have multiple different layers of tax that does sit on top of that base premium. Dependent on the product as well, you will also have a terrorism levy inclusion if your insurer has actually opted into that program, which forms part of the base premium calculation. And when you're going through any sort of audit or review from a regulator, you need to be able to demonstrate that those taxes do calculate off that base premium. And if you are an insurer that is party to the ARPC terrorism levy reinsurance program, that base premium is in fact the terrorism inclusive levy. So from an indirect tax perspective, it turns all of us businesses into an actual tax collector. We are doing the job on behalf of and for the regulator, so they get their taxes paid. And what that does is includes a whole bunch of both sides of the coin, which when added together, you can actually really dwarf the overall income tax liability any organisation. And just speaking off cuff, GST by and large, when you consider both sides of the equation, your obligation and your pay and the creditable amounts, making sure you manage both sides of those and the taxes actually under management, not just the net payment. It's usually the largest behind your PAYG on employee income. Mark, if you wanted to go, Mike, off to the next slide. So this is just the basic formula, and most of us would be aware of this, particularly if you work with taxes quite a bit. But for those that aren't very familiar, this is the formula for any GI product that is issued in Australia. So you do start with your base premium, which is, as I said, inclusive of that terrorism levy where applicable. You apply any emergency services levy where applicable, dependent again on the product and the state. On top of that comes GST, and on top of that comes stamp duty. So that equals your total premium payable. So I've just put a bit of an example down there of a New South Wales commercial property. The rate, ESL rates, as most of us would know, are not a government mandated rate. So I've used an average rate that's around the market of around 30.5% for commercial property. But you can see on a $10,000 premium, it adds very, very quickly another $3,050. You then calculate your 10% GST on top of the addition of the two, and then a 9% stamp duty rate on top of that. So your $10,000 base premium actually becomes a $15,600 premium payable by the customer. So that's a 50% increase of what the insurer is looking to price their products at, that the customer has to pay in order to satisfy all the taxes that the different regulators are wanting to get on that premium. So it's quite sizable, and a 10,000 commercial property premium is probably on the lower end. They can be some pretty chunky numbers when you're looking at sizable risk. Mike? So as I just stated, it really increases the cost of insurance to customers, and it's been a really big focus of the ICA and even different tax reform reports that have come out over the years. I know it started in the Henry Review. They've certainly discussed it in individual state white papers about some of the inefficiencies of these premium taxes and the levels of underinsurance to which it might promote. And depending on which state you're in, each legislation, particularly around duties, is really quite different, and how they apply it and when it applies and what the exemptions are really takes some detailed understanding of what it is the state is trying to achieve. And I've just put a few examples up there. You have a very specific New South Wales small business exemption that has some very, very detailed compliance around that. There is charitable organisation exemptions available specifically in Queensland and New South Wales, but not more broadly across the country. Victoria and New South Wales introduced some agriculture exemptions, and then the life insurance industry has their own issues around stamp duty on where it is exempt, dependent on the state, where it isn't exempt and it's rated differently, where riders are treated a little bit differently as well, depending on the state that you're in. So stamp duties on insurance are really quite complex, and they're very, very difficult to comply with easily. I've got a point there, ESL in New South Wales. For those of us on the call that are tax folk and have been had the pleasure of working through this tax for the last few years, it's an absolute nightmare to get it right, and the way in which the regime is set up makes it really, really difficult to ensure you're meeting your obligations correctly. But one of the main fundamental things with all of these indirect taxes on those premiums is that these are insurer taxes. They're, in the first instance, they're the obligation of the insurer, and if we don't collect it correctly, the obligation doesn't always change, which in turn can become an insurer cost, which then leads to a lot of burden in the administration processes, a heavy reliance on non-tax focused areas of the business to get it right, and very, very complex calculations and reporting and data requirements to actually support and back up any of those compliance activities and lodgements that we do put through. So whilst it is tax, and tax is best placed to take responsibility, I guess, for the compliance of these indirect taxes on our premiums, there is a heavy need to get the rest of the business on board and make sure they have a vested interest in getting it right up front, which reduces some of the complexity and risk around the actual lodgement at the back end. Mike? So this is one particularly for, and it's not just, you know, brokers and commissions and documentation, it's really around documentation and your GST recovery. But you have your AP and your general expenses, but one area where documentation can either slip or be delayed or incomplete is with regard to the documentation that we receive from our brokers, be it in a bordereau, be it in a closing, all in relation to some of that larger business where there is a commission expense. And most intermediated business around the industry is largely settled on a net cash basis, meaning the cash that comes back to the insurer is the net of commission expense to the broker. But what that means is we need to make sure that we're not only accounting for it properly, which is your gross premium and then your commission expense, but that the documentation that's actually supporting those transactions is valid for GST recovery. Missing or incorrect broker closings really does compromise the insurer's ability to include and recover the input tax credits relating to that commission. And one way around that is recipient created tax invoices, or RCTIs, issued by the insurer for that expense. It does drastically reduce the risk of not holding valid documentation at the time of GST recovery. But like with any RCTI, you do need to make sure that both sides are on board, be it by virtue of an actual clause in a contract, which is the way they were first intended, or by the embedded wording as prescribed by the ATO on the actual document. But making sure that you do have that documentation there to support those input tax credits is actually really important. So I'm going to try and do claims and GST in about 5 minutes, which is, for those on the line that are familiar, completely impossible. So these are really, really high-level principles. But the GST that an insurer will incur in relation to a claim and the recoverability of that GST is largely governed by Division 11 or Division 78 of the GST legislation. Division 11 is the broad GST recovery provision available to all GST registered businesses for their purchases that relate to their business. And under Division 11, it's the recovery of an input tax credit or an ITC or the GST you are charged, and requires the acquirer to have made that acquisition in the furtherance of your enterprise or for your business and be supported by a valid tax invoice. There's rulings and there's lots of commentary around, you know, in the furtherance of an enterprise and how an insurer can validate that they did in fact make an acquisition in their own right to be able to utilise Division 11 ITC recovery in a claims environment. And that, if you're interested, can be discussed further in another session. But by and large, if the insurer has approved or authorised a acquisition upfront in a claim scenario and has a valid tax invoice in its or its agent's name, that should be enough to actually support a Division 11 ITC recovery. Next, please. Division 78 is everything else that doesn't fall into that Division 11 criteria. And Division 78 is the general insurance specific division, which governs how you actually treat and deal with GST in a claim settlement situation. And claim settlements for the purposes of Division 78 could be an actual cash settlement, it could be a reimbursement to a claimant or insured, or it could be an acquisition that the insurer did not actually authorise or approve upfront, but agreed to meet the costs of after the fact. Where there is no agreement or buy-in from the insurer upfront, largely everything will fall into Division 78. Once you get into Division 78, though, the ITC recovery is not the driver of the GST treatment and what can and cannot be recovered. And therefore, valid tax invoices are less important once we're in Division 78. What Division 78 allows for is an up to 1/11th decreasing adjustment that could be available dependent on our insured's ability to recover GST on the premium they paid for the policy. Now, there's even bigger rulings and there's more commentary around how exactly Division 78 applies. But broadly speaking, for a business customer in an Australian landscape, you would expect that most of those would be registered for GST and therefore have a full entitlement to recover the GST on the premiums that they paid. In that sense, there would be no decreasing adjustment available to the insurer in a Division 78 claims payment to them. Conversely, a personal lines customer, mums and dads, myself, we have traditionally no ability to recover GST that we pay on our premiums, and therefore a decreasing adjustment equal to 1/11th of the payment made to that customer is available to the insurer. As with everything in every tax law, and particularly GST and particularly Division 78, there are always exceptions and there can be limited decreasing adjustment availability dependent on that ITC entitlement, and if there is a mixed business or an input taxed insured, or if the premium itself was GST free, then this alters the ability for an insurer to get a decreasing adjustment back. But in broad terms, if you can't get something under Division 11, it falls into 78. And once you're in 78, you're really, it's really important to understand your insured's ability to recover GST in their own premiums. I'm going to do that in about 3 minutes. Done. Sorry, Mike, next. So as Mike talked to, the ATO kicked off an income tax justified trust initiative a few years ago, and they started with the top 100 and then extended that out to the top 1,000. About 2 years into that program, they identified, I guess, benefits with the review that they were doing and brought the scope of that regime out to include GST. GST, though, is still quite behind where they're at from an income tax perspective, but they do have definitely that top 100, top 1,000 lens, and the top 100 gets the benefit of a much more detailed occupancy from the tax office, and they're working slowly through those top 100 entities for GST purposes. The benefits from a GST perspective is that all of that governance and risk assessment and controls and board management activity that has been undertaken within your entity through an income tax justified trust review actually is what supports your GST justified trust review in the first instance. The ATO has been quite verbal about utilising the information that they already have to the extent that they can, so they're not asking the same questions of different people within a tax function. But the GST review definitely has a different look and feel to it, and the real focus is on data, it's on business systems, it's on process maps, it's on how does something get into a source system, flow through all of the necessary channels and end up correctly on your BAS. And from my understanding, having not had the pleasure of being deep in one of these just yet, it really is a transaction to BAS type mapping. And that could be across insurance, it could be across multiple insurance systems. There's a definite interest in Division 78 because of the complexities. There's a definite interest in your accounts payables within your business and how accounts payable works and the documentation support around accounts payable. And particularly if you do have fragmented support functions, if they're offshore, how does the governance work on that, and making sure they understand the tax invoice requirements, both in a general insurance claims perspective and not. So there is a real focus on that data, business systems, operations type area. So in order to satisfy the ATO, it's we've got to do more than prove our technical prowess and our ability to interpret the law. State governments, they will continue to be active and I expect possibly more active, considering they're all starting to get a little bit poor on the back of all of this COVID-19 situation. The state government's audit activity tends to fluctuate dependent on their budget deficit or surplus, I find, and that's in payroll tax, that's in insurance duty. But from an insurance duty perspective, they will either holistically look at your data and see how you apply their rates, how you apply their exemptions. They will look to see if you're using the right rates, or there could be something that's quite issue specific. And for those of us that are in the duty space that are on the call, you've probably experienced both, and you probably have many war stories about how dealing with some of these audits, particularly in insurance duty, can be quite difficult. Even though there was rewrites to most of the legislations in either the late 90s or the 2000s, they're still based on very old principles with old terminology, and trying to bring those into a commercial reality can sometimes create conflict between both the business and the regulator. But they have been more open over the last few years to discussion and liaison, and that has really helped, I guess, make sure that insurers are comfortable with how they're applying insurance duty principles, but not only that, provided an avenue for discussion and query if there's something that's not quite clear. New South Wales ESL has had such a significant focus over the last 4 years. It's had multiple regulators with multiple legislations and multiple versions of where we were at in the ESL journey. But I think we're all quite comfortable now that New South Wales ESL is here to stay for a little while. It will stay in its current form, which means there is no legislated rate, there is no guidance as to how and what to collect. It's really an actuarial relationship, and a relationship with your internal actuarial department and your business departments, about trying to understand what the market looks like, what our share of that market looks like, and try to come up with a rate that will assist you in getting as close to your end obligation state as possible. It should calm down, I think, in over the coming months, and we'll get to a new place of monitoring. But that is something that's going to continue, and it's going to have particular focus when you think about the bushfire activity that we've just had, and continued expectation that bushfire activity will increase. And last but not least, there's just such a focus globally on the international tax landscape, both from an income tax perspective, but more and more we see consumption taxes and what their contribution to the overall global tax base can really do. And you've already seen some jurisdictions start to introduce digital services taxes. We ourselves have got our Netflix tax, and they're all about taxing the consumer at the place of consumption. And it's a bit of a switch to having your tax on the sale. It's more about where is it being consumed. And I expect over the next few years to really see a broadening of how consumption taxes actually will be used to prop up what could be quite a reduced income tax base if you see a decline in income tax rates or income tax markets or industry or whatever. But that, I think, brings me to the end. I'm not sure if there is another one, Mike. I can't remember. I don't think so. I hope that wasn't too quick or too high level. Patrick has put a question up here. Corinne and Michael, what is your hope for possible future tax reform and changes as we move beyond the COVID-19 environment to an economic recovery phase, both in Australia and globally? We're actually, Michael, I'm going to start here, but I'm sure you've got some points as well. There's a cabinet meeting, I believe, happening tomorrow, like, so from an Australian perspective, happening tomorrow or early next week, where what can they do with tax to reinvigorate, I guess, the economy, considering its current landscape. And I read a line in a newspaper article, I think it was the Treasurer, that said everything is on the table except GST. Whereas I think 3 days earlier, an article, the Treasurer had stated everything's on the table and GST included. I think there needs to be real discussion around GST, and I'm not advocating any one way or the other. Everyone can get quite passionate about whether they believe GST should increase, decrease, what that does for the market. But I think it's a really sensible discussion that needs to be had, not only about rate changes, but also base changes. And you can sort of see the logical argument about broadening a base to reduce, I guess, an exceptionally high rate increase, but then removing some really inefficient and targeted smaller tax bases. But in my mind, I think from a global perspective, I would expect to see a lot more focus in the coming years on what consumption taxes and things like a GST or a VAT can actually do for the overall tax compliance and in the international tax landscape. But that would be my thoughts. I think we need to have a sensible discussion around GST, both federally and bring the states in. Mike?
Yeah, I totally agree with what you've said there, Corinne. I'd say that tax reform that promotes economic growth is what we should be targeting, and in the income tax land, we've been agitating for to get that headline tax rate down for many years. It's currently at 30% for large taxpayers. And it puts Australian businesses at a global disadvantage when you look at our peers. So USA, UK, I think is now 19% tax rate. So automatically we're at a competitive disadvantage just by virtue of the corporate tax rate. So yeah, it's something that's been agitated for. It's certainly something that the Morrison government is considering, but whether we see that materialise off the back of COVID as well, and whether as well, the whole piece about global competitiveness is still as relevant tomorrow as it is today, given movements to onshore some of those I guess primary industry type and manufacturing type jobs. So yeah, bit of a watch this space, I guess.
Just monitoring the Q&A for any further questions. I just want to, I guess at this point, express a thank you on behalf of the FSAA and all our members to you both, Corinne and Michael, for this presentation today. I think it was fantastic the way you were able to summarise all those concepts into like 50 minutes, which is amazing, given some of the subtopics you could spend days on. I can appreciate. Yeah, so I guess we could bring it to a close. Although we do have one question here. I guess if we do have a couple of minutes, if that's okay with you.
It's an interesting question. How will the general
Question anonymous.
Yeah, how will the general insurance industry pay for the cost of COVID? Won't this mean increased taxes for insurers and all? Yeah, it's interesting. I think it's about finding the right strategy, right? So tax certainly plays a role, but there's some taxes are more efficient means of collection than others. I think that's widely accepted. New South Wales were agitating for removal of stamp duties on property, which is a big money spinner for them. But they recognise that people are less mobile when it attaches to property. So, there's been all these reviews with all these recommendations done in the past, and to be honest, there's been no little action on this and on that, and we can only hope that if you know that off the back of COVID that we do see reform.
Yeah, I mean, from an indirect tax perspective, what you could really see, I mean, if you think about, I mean, I have absolutely no idea from, you know, just how many of these businesses that had to shut, you know, temporarily, how many won't actually be able to open their doors again. And I think that's something from a general insurance industry perspective, we're all looking for. But from an indirect tax perspective, and if I had to think of New South Wales in particular, anyone not insuring isn't contributing to the FSL budget. They're not contributing to that insurance duty revenue. Then there's no GST revenue on that, and removing an insurer's premiums in its own right. There's a reduced tax flow there to the regulators, and what you don't want to see is that either some of the initiatives that they've put in place to remove or benefit particular policyholders either get diminished or they don't get expanded, or they bump up rates. I mean, that's the last thing you want to see. There's no talk around that at the moment, and you don't know what they're going to do. You would like to think from a state base, they've also got everything's on the table kind of discussion happening. But it's a really good watch this space, I guess. But it's an interesting time.
Okay, I'm not seeing any other questions, and it's probably nearly 1 o'clock. So once again, maybe we can call it a day on this for today. But yeah, thank you so much for your
Thanks for having
contribution today.
us.
Appreciate your time, and I know it's no small feat pulling this together, and I know I got a lot of benefit out of it. I hope everyone else did too. So thank you, and hopefully see you all at the next webinar.
Thank you, everyone.
Thanks, everyone.
Bye.
Bye.